How would you like to do this? Do you have a keynote for us? Do you need to share?
Yeah, I have some slides actually.
Wonderful.
Yeah, and I would share my screen now. Yeah, so this was supposed to be about DeFi for financial inclusion. And just to remind everyone, I think we're all well aware about the challenges faced by traditional banks. You know, it's that they're being so slow. I mean, literally, probably even today, it would be faster to get some cash from a bank telling machine and fax it through China. That would probably be faster and cheaper than to try to send it through the traditional banking system, right? So, you know, the slow digital transformation is a problem, and banks have been incredibly slow to undertake any kind of reform on that. And their online footprint, still today, that's true for many banks, at least in this part of the world here in Europe, has been limited to offering very basic services like deposits, transfers, credit application, bill payments. And that has left them unable to reap the benefits of the next gen IT solution. So there's a report by MIT saying going digital can actually reduce the costs of banking by a massive 60 to 80%. So that's a market opportunity right here, but slow movement has made it impossible for banks to function viably in this scenario. And then, I mean, one reason is that they're held back by their legacy infrastructure and old data sets that are still being used. And this causes that most banks prefer risk averse and they skip the adoption of innovation completely. And the emergence of disruptive banking models, whether it's payments, investments, mortgage, or personal lending, it has begun to substitute every single service from the traditional value chain. So, you know, no one wants to stand in long queues, submit tedious documents, deal with complex systems. And when you can, you know, go along with a fintech player and open an account on Easter Monday without a problem. It is true that the traditional banks suffer from strict regulatory standards because every conventional bank has to comply by the regulatory standards set by its supervisory authority. So for example, Indian banks are required to maintain a capital asset ratio, a cash reserve ratio, and a statutory liquidity ratio. And European and North American banks are supposed to follow regulations like PSD2 and MIFID. And if they fail to obey these regulations, there's a hefty cost of misconduct. So banks are paying about $270 billion every year just to meet their regulatory observations. And then since the financial industry, like the pharmaceutical industry, they're very attractive industries. So the tech giants are coming for these industries. And I'm sure Amazon will go to the pharmaceutical industry just, you know, because it's so large and one of the few industries that can sustain its growth. So to counter that technological invasion, banking networks are really left with no option but to try and leverage the power of partnerships with these companies. And, you know, another challenge is to maintain the brick and mortar branches, you know, cost of land, staff salaries, training, capacity management, overhead costs, maintenance costs. If you think about it, you know, there's a lot of money just to, it's like the tip of the iceberg just to maintain the traditional financial system. And yeah, probably most importantly is the lack of proper customer engagement. You know, maybe you have heard the results of the millennial survey, the people born after 1980s in the US. And in that survey, they said 71% of the millennials said they'd rather go to the dentist than set foot into a bank. So that is a problem for all you traditional banks. You know, once a person has access to financial services, sending and storing money, their own money, should be inexpensive and fast, but it's the opposite, right? Around the globe, the average cost of a remittance is 7.01% in fees per transaction. And when using banks, it rises to 10.53%. So even worse, these transactions, as I said, can take days at a time, and it can be uncertain when the transaction will be completed, completely unnecessary in this time. And billions of people globally remain without bank accounts. To participate in the global financial sector, whether it is to make a digital payment or manage your wealth, you must have a bank account, and around 2 billion adults worldwide remain without a bank account, having zero access to a financial institution or even a mobile money provider. Similarly, global financial literacy remains low. A recent survey showed just 1 in 3 people show an understanding of very basic financial concepts, with most of these people living in high-income economies, so it's not limited to parts of the world. And the financial sector is the least trusted business sector globally, with only a 57 level of trust, according to the Edelman Trust Barometer. Well, yeah, amongst the rising global inequality. So in a centralized system, financial markets tend to be dominated by those who are best connected to them. And these are people who have access to financial opportunities and asset classes, capital to deploy, and informational advantages. And according to recent data on global wealth concentration, the top 1 own 47% of all household wealth, while the top 10 hold roughly 85%. So on the other end of that spectrum, the vast majority of people who have little to no financial assets to even start building wealth. Not only are many people living paycheck to paycheck, but they simply don't have assets to create wealth, like stocks, bonds, mutual funds, let alone cryptocurrencies. And yeah, I mean, this is something also relevant to the topic. So reducing the purchasing power of money is similar to a form of taxation or expropriation, where the real value of one's money is reduced, even if its face value remains constant. So that's what has been happening, and probably will continue to happen. This is the slide, right, I meant to show earlier. So we are here basically, you know, in Web3 in the age of 1997. So crypto adoption curve is very similar to internet adoption curve between 1992 and 2006. And we are early, so yeah, that's good news for all of us who are here. And the financial markets have remained segmented over the last century, both geographically and by asset class, in large because of the 2 forces, information friction and regulation. And blockchain, of course, promises to ease both constraints, because blockchain networks automate intermediation. And when ownership claims on financial securities are recorded using blockchain protocols, they're more easily traded, transferred. They can be bound by smart contracts. And friction around regulation can also be alleviated by blockchain. So security tokens are digital wrappers for ownership claims. And so this the implication is that many elements of regulatory compliance and settlement that are currently managed by external systems will be hardwired into the architecture of the security. And automating compliance makes cross-border trade more feasible, operating and opening up global markets. So yeah, both are solutions for that. And the day will come when digital wallets are as commonplace as email addresses are today, and we'll use them for everything from receiving income to sending payments and managing our investments. And, you know, financial inclusion, as I've said before, starts with having an account and using it. And it's the access to and use of formal financial services, and that would enable those people that currently don't have an account to safely store money, make and receive payments, and manage risk. About almost 70% of those without a bank account have a mobile phone. And so the World Bank says financial inclusion means that individuals and businesses have access to useful and affordable financial products that meet their needs: transactions, payments, service, credit, insurance, delivered in a sustainable way. And another definition says a process that ensures the ease of access, availability, and usage of the formal financial system for all members of the community. Women, as we know, are less likely to have an account, and they face more restrictive collateral requirements, shorter maturity of loans, and higher interest rates. But, you know, despite all the innovation that DeFi might bring, you know, if we really think about it practically, you know, so if you're challenged with setting up a traditional bank account, for a layman, you know, DeFi, as of now, is so much more difficult to use than traditional money services. It's not currently designed to remove the main cause. Think about it. What do you think is the main cause that so many people, at least 1.7 billion people, don't have bank accounts? Some people think it's, you know, because the technology isn't there, and that technology would be the solution. But there are several studies that actually indicate the reason why they don't have bank accounts is that they don't have enough income or money to put into these bank accounts. And even though there are several initiatives in the eager, venture capital money is flowing into these initiatives, such as promoting DeFi for a better Africa, they may just not address the main point that these people remain without bank accounts. I mean, in theory, decentralized finance with being permissionless, meaning anyone can access the financial services from anywhere in the world, just with electricity and an internet connection and some internet device. In theory, it means great, we'll solve that problem that people are not participating. But that's only true, if you believe it's easy enough to use. And then, and it's a fantastic article by Yaya Fanusi saying that the main assumption is that the lack of financial services is not primarily that they need a better way to access them, but to make more money, to participate in markets actually that allow them to generate an income that they can then put into these bank accounts. And a World Bank report looking at financial inclusion globally noted that 95% of the people who responded to the survey also cited lack of money as the main reason for not having a bank account. So interestingly, a second reason was that people depended on a family member who already had an account. So that indicates that cultural and familial factors greatly influence whether you can get banking services or not. In a study from 2016 from South African University, looked at subsistence farmers, and the study found that access to markets was key. So poor farmers tended to have bad transportation infrastructure for delivering goods, lacked adequate business management. They had little insight into market development and pricing. So markets for their products existed, but the farmers were unable to take advantage of them. So it may be that it's not DeFi that's the solution. It is more, Web3 and the blockchain economy, which I think will, we could also call the creator economy, where by removing intermediaries, we will hopefully democratize even more access to global markets, sourcing of people who have something valuable to offer. Addressing the possibility to make money would be great. And when it comes to, is DeFi really the solution? Probably not as of now, because it's really complex, to use DeFi. Probably using mobile phones, mobile money instead of DeFi would be more convenient. Financial inclusion, if you can manage it, has a positive impact on economic development, equality, and stability. So access to informal loans has been found to have a positive effect on the ratio of 40. And financial inclusion could enhance the stability of the banking system as well. If more people use deposit accounts, banks have a more solid funding base. And there is a shift needed, as I said before, that it's more of a market problem, not a banking problem, if people, if there is a lack of financial inclusion. And supply and demand side indicators can be used to measure the degree of financial inclusion across the dimensions access, usage, and quality. So transaction costs, the three dimensions are commonly used to measure this. So access, number of bank branches, ATM, mobile money agents, access to mobile phones, or usage, received wages into an account, made payments using a mobile phone, etc. And then also quality, the quality of the services, choice between more than 3 branches, cost of banking services, convenience, time spent waiting, etc. And financial inclusion indices can be constructed to measure the progress in financial inclusion across time with a single number. So because banks are the gateway to basic financial services, banking inclusion is used analogous to financial inclusion in the index by Zarma. Banking penetration means the percentage of people having a bank account, availability of banking services, or the number of access points per 1,000 people, and usage is the volume of credit and deposit as proportion of a country's GDP. There are several public databases that are already being used in the literature to study the extent of financial inclusion in different countries. So there's the Global Findex database, the International Monetary Fund Financial Access Survey, and World Development Indicators by the World Bank. And the further data sources for those interested, like the Bank for International Settlement, that looks at the volume and value of cashless transaction and withdrawals, deposits for 27 countries, and the World Bank Global Financial Development Database. So the financial sector covers 5 broad functions for different user needs. New technologies can address gaps of the traditional model in each of these functions. So the figure maps users' needs for financial services to traditional solution and emerging fintech solutions. So in doing so, it flags the key gaps that technology seeks to fill and which new technologies are applied in different services. And in gaps, transparency encompasses search and matching frictions, while access encompasses product tailoring needs. AI, ML refers to artificial intelligence and machine learning. Algorithms applied to extract insight from large amounts of data. And access to digital platforms can be secured with digital identification technologies such as biometrics. And distributed ledger technologies and crypto capture distributed ledgers such as smart contracts related decentralized technologies. And so DeFi can potentially address some of these problems, but for example, it cannot give financial advice today really well. So if we look at some of the research, and there is not a terrible lot, what are some of its shortcomings of the research on financial inclusion? So research is mainly focused on traditional ways of accessing the financial system. Users can have a bank account but be inactive and rarely use it for transactions in their daily lives. Bank branches and ATMs are becoming less important for accessing and managing one's finances. Therefore, banking inclusion is not the same as financial inclusion. And even if people have a bank account, it doesn't mean they can access all financial services in a fair and equal way. And in most literature, it's assumed that there's a link between DeFi and financial inclusion because of lower costs and easier access, but it's rarely explained in more detail why and how DeFi could increase financial inclusion. And some of you that may be interested in doing research, some of the research questions we look at, what are the determinants of financial inclusion? Does the use of digital financial services lead to more equal and inclusive access to voluntary services for women, low-income groups? How can DeFi increase financial inclusion? Which gaps can it fill? And for what types of user needs can DeFi be applied? What are benefits, problems with regard to financial inclusions? And what are the basic requirements, the infrastructural requirements for this technology to take off? Thank you very much, Ryan. And with that, back over to you.
Thank you so much. A really insightful piece on the various different factors for financial inclusion. I thought you brought up some really good points there. Thomas is very active in the Q&A, so I'm going to ask at least one of his questions. So Thomas asked, with so many problems with regular banking, why is there not more uproar and change happening? Would these issues, if known, cause more problems than good by creating scared consumers? How can we implement DeFi where it is a smooth transition?
Yeah, I agree. It's really true that using traditional banks is slow and really expensive. So, I guess people as organizations are creatures of habit, and since most of us have been doing, financial services in the past 10, 15 years through the traditional regular banking system, it requires a change of habit or start something new. And we know that's always slow, or you need a peer to tell you, or a friend, or as we discussed earlier, you need to see it on TV. But really, there is no rational reason to keep using at least for many services, the regulatory banking system. I do find the point interesting that, for large parts of the world, probably it's not, the main problem is not that it's so regulated. It's really a monetary issue. It's not so much financial inclusion. What they need is market inclusion. And there, I think, that's where Web3 will generate even more equality and democratic access, because let's face it, we all buy and sell globally our products, but when it comes to talent sourcing, I don't think a lot of companies do that very globally. So our value chains, when it comes to hiring globally, that will probably change. There's lots of room for globalizing talent sourcing, and that will bring, I think, a lot of financial inclusion through market inclusion.
Absolutely. So, I mean,
Thomas, just write me an email. I will send you the presentation, and we have the links in there.
You can verify all of your sources directly. I think that's fair. We'll leave that out of the conversation. A lot of your conversation went around, the kind of the on-ramps, the access, the ability to be able to access these services. I think you made a good point around that, especially with DeFi sometimes being quite complicated for new users. So being one of those issues. What we've seen in the wider market as well is that fintechs have started to look like crypto companies, and crypto companies have started to look like fintechs. And then we've even had, traditionally social media platforms, a la Facebook, starting to launch wallets and stable coins and doing various POCs. Do you think there's a possibility that maybe this next onboarding of Unbanked might actually not happen from the banks themselves, actually comes from other actors who are quick at the market?
Yeah, the general pattern we've seen is that, the competition in the digital world is not, for Germany, it's very unfortunate. It's not a technology competition. It's a competition for the pole position with the customers. And whoever has access, direct access to customers, every company will win. And so the pattern you've seen is newcomers coming between market leaders and their customers without, as you had to do before 2007, you had to rebuild the whole value chain in brick and mortar business, and that protected a lot of the incumbents. The banks, they felt very safe, they felt protected by that and regulation, etc. But we've seen, you come in and the only thing they do and they start is to listen to what customers need, when and where they need it. And they tell the customers, don't worry, we'll take care of it somehow, we'll reorganize the value chain. Don't worry about it. So yes, absolutely, I do think that. And decisive really in a digital age are operating systems, aren't they? I mean, Apple CarPlay, in the German cars, there's Apple. The Apple ID, Apple, Google, Facebook are probably the most prominent examples of people who could contact all of us who are listening here. And so unless Europe, I think, gets going and uses now the change, technology moves in cycles, and we're moving from the centralized model with the silos, the data silos and the platform monopolies, to the decentralized economy. So there's opportunity to build a better operating system that addresses the pain points like paying without data or not being able to pay directly through our browser and our wallet, etc. I think that yes, it'll be companies that come in between the people. It doesn't have to be customers, just people from users of your services, they can turn into customers later. And we've been terrible at that so far. And I hope dies last, right? That in the next technology stage, we come up with our own operating system.
Absolutely. I think it's a great debate on whether, existing large user bases from, more Web 2 traditional models are able to evolve quickly enough to be able to, allow the user to gain some semblance of control and value, which goes back to them and, have this, as we talked about earlier, flywheel, which allows them to continually grow users, or if it will be someone who is fresh, new, with only their eyes on the prize of building something out very native and specific, and if they'll be able to reach those economies of scale quick enough before those incumbents.
I do think the creator economy will probably do more for economic inclusion than one single technology, DeFi alone, just by enabling everyone globally to offer their skills, their talent, whatever it is they can teach, they can create anything really, whether it's design or it's code, attach whatever is your IP, and you can now with blockchain technology, you can create something, and you can even participate in after sales, right? So it's good news for every company, for every individual who creates something original, because then even if it's resold, you can put it in the smart contract, that every time you get maybe 1-2%. So that I feel will do more for inclusion probably than technology alone.
Yeah, absolutely. More money to the creators and improvers rather than the middlemen who are actually allowing that.
Yeah, that said, I think, that with the first web, we were promised decentralization and democratic access, and we are promised this again. I'm fairly certain we will see new intermediaries. The only difference maybe being this time that it will be optional to use them. So maybe if you want extra layer of security in transacting on a Web3 marketplace, you could opt in to use an intermediary, but you could also decide to go without and then maybe save some fees, something like that.
Very good. Dr. Welpe, thank you so much for such an informative presentation.